In Charlotte with Brian Moynihan. Brian, it's a pleasure. Good to see you.
It's great to be here. Thanks.
So you reported earnings earlier today. J.P. Morgan reported last night. Wells Fargo, we're in the thick of bank earnings season. But your results are noteworthy because for 2 quarters in a row, you've had revenue north of $20 billion, and you're averaging quarterly earnings of about $5 billion. Consistency from a bank where shareholders haven't been used to it over the past couple of years, because more than a couple, in fact, because you've had so much work to do. Can you keep it up?
Sure. It was. So I think you have to step back a little bit and think about what we were telling people all during that time was underneath all the noise in the mortgage litigation, or pick your topic at the given moment, there was a core earnings power that was always there. And it got covered up by other stuff. And now as that's come off and gone down, and last year this quarter is when we settled with justice, and we've had 4 quarters that have continued to stack up, you really just seen that core earnings power to come through. Now, that doesn't mean we don't have market share to gain, we don't have hard work, we don't have to manage expenses, the environment keeps moving around a little bit on everybody. But the reality is that what was there, and now you're seeing it shine through, and now the question is how can we improve upon that, and that's what we're focused on in the company.
In a better environment, how much more money could this bank make?
Well, we talk about, a simple way to think about that is to think about in the U.S., if rates go up 100 basis points where they are now to 1.25 Fed funds rate and 3% 10-year Treasury rate, very low rate structure, we make $4.6 billion pre-tax per year just for that first move. And so that
incremental profit.
Incremental profit.
So and that's on a pre-tax basis over and above what you're making now.
And that we disclose each quarter, and that is because effectively we have our core franchise is taking deposits on the liability side, and there are 0 floors. And so, we can't charge customers, and so we pay 5 basis points for deposit pricing and across the franchise and consumer business, but it can't really go down anymore. So as rates rise, you'll be able to capture back the spread we traditionally had.
So I referenced this before. For almost 6 years, you've been the CEO, and you've been trying to get this company to a place. Is it there yet?
It's there. It's there, but it's not where we want it, because we get up every morning. But think about the last 6 years. And we try to give the frame on this. We have a $15 share, $15.5, $15.75 share price today. We took $12 in charges on a per share basis in the last 5-6 years to fix the mortgage crisis, the hole that was left in the capital base, all the different things. And, that's behind us now. Our capital ratios are where they should be. We're generating good earnings. So is it fixed? Yes, it's been fixed. But the question is how good it can be. That's still ahead of us. And that's what I sit back with the team, and we just go after and drive. And you see that every day in how we execute.
So what's left to do?
Well, we have 8 businesses, and 6 of them are the growth engines for our company. 2 of the businesses have constraints on them because in general retail banking, we have to be careful that they'll get the full relationship with customers. In markets, we've constrained its size relative to our company because we saw, or we thought we saw, or maybe we saw more than we should have seen, but we thought that there would be restrictions on, capital and liquidity that would kind of keep in that check. But the other 6 businesses...
was that right, or are you looking back on that and saying it was wrong?
That's why we're LCR compliant already. That's why our SIFI buffers are lower than other people relative to our size. So we get what we need out of the business, serve the investors well. #1 research platform in the U.S., just announced the last few weeks. So as you think about that, the other 6 businesses, which are serving affluent customers and wealthy consumers, and then middle market companies and small businesses, all those businesses just have to grow in our corporate investment banking. And that means more salespeople invest in those businesses. And that's what you saw today. We're down. Headcount continues to work its way down in our company. That's the expense mantra that we all talk about. But the reality is, in this quarter, we hired over 1,000 new kids in from school. We added 1,000 client-facing people, and we were able to manage through hard re-engineering work 1,500 net people out of the company. You have been able to reduce expenses to the point you just made, in part by reducing headcount dramatically over the space of the past 5 years. Yet, if I compare Bank of America to some of the other banks in your industry, the comparison could still be more favorable. Wells Fargo has an efficiency ratio, non-interest expenses as a percentage of revenue, in the order of 57%. You guys are north of 60. Why can't yours be 57%? There's going to be differences in business mixes, but ours should be better. And so we're running better than it is today. Better than it is today. And that's going to come, one of those issues is, our net interest income is compressed because of things we had to do with the portfolio over the last few years that some of our competitors didn't. So that's that increase in the rate rise. A second reason is we're still carrying on $900 million a quarter of LAS costs, or getting the
legacy
money
stuff.
Legacy stuff. It's the cost of doing a great job of modifying mortgages. Now they're coming down, and there's a lag to that. And the other is just sort of, as you shrunk the company, kind of getting the stuff out, and that takes time. So we need to drive that down by probably 500 basis points, and that's going to be by a combination of revenue lift as we keep growing the balance sheet. Even if the rates don't rise, we just drive incremental growth, and then continue cost takeout. And that's the goal. So we're not.
So if we stay lower for longer, which is the way it looks for the time being, you think you can get that efficiency ratio into the 50s?
No, to 60. We're
to 60.
65. We've got to drive it down. But and it'll take longer if rates don't go up. It'll come faster if rates go up. But about half of that would be driven by cost management, and the other half's driven by rates, and round numbers just to give you a sense. And
how do you take out $2 billion more of costs? I mean, look what you've already done.
Well, we've said that LAS has run about 900 a quarter.
Okay.
And we've got a plan to get it down to 500. That's not good enough, but there's 400 a quarter right there. And then on top of that, the real key is on the core expense base is how you keep investing in growth but not have your costs go up. And that's just incremental efficiency. And what you've seen quarter after quarter, the last four out of the 5 quarters, we run about 12.7 to 12.8 in incremental in core cost, and we've been able to keep it there while we've invested. And that's what we use this project called SIM. SIM is just improving our company. It's incremental ideas. It's many of them, and you just constantly work.
Can you do it without bringing headcount down further?
Well, the headcount will come down because we're 60% people cost. If you can't save money without, there's not enough other costs to save a lot of money. But the question is how you do that. And for a while, we had to do that very quickly because the LAS costs were coming down fast, and we had 58,000 people were down to 12,000 or something like that. So I think we had to build it up and then bring it down. And then in other areas like our retail system, we went from 100,000 people 6 or 7 years ago down to about 60 today with more salespeople. So, but a lot of people say, well, how you do that? Well, every quarter, just through normal attrition, there's 4,000 or 5,000 people changes in our company. And what we've been doing is, when someone's job comes up and someone leaves for whatever reason, that's a low attrition rate on 215,000 people. We basically say, do we need to replace this job? And then a lot of jobs you do, and a lot of jobs you don't.
Brian, what do you do if the U.S. economy starts to slow again?
Well, I think the question will be, what do we see in the business statistics? So the U.S. economy is still running way below trend, as the economists would call it. And we're seeing more card production, more mortgage production, more checking account production. So as long as we can keep producing, you then kind of run and keep operating. If you said because what was going on in the economy caused business activity to slow to level, you would start to pull up.
You don't change your strategy.
The strategy is fairly straightforward. It's you have clients, you take the best products in the world that we have. We're number 1 in pick your product, or number 2 or number 3 across the board, and you just keep driving the integration of products for the benefit of the customers. So that's not going to change. Great client service, great client salesmanship. It just says how many more financial advisors can I add in Merrill Lynch afford to? And it's a question of judging the opportunity to get them successful.
But you must understand what people wonder. They look at Bank of America and say, this is the company that's supposed to be a leveraged bet on the U.S. economy. And they see revenue not growing, but shrinking at a time when the U.S. is the fastest growing economy in the industrialized world. What's wrong with that picture?
Well, the issue was we had the rundown in revenue had a lot to do with loans and loans and especially loans, but other assets that we had that weren't core, and we ran those down, and that's pretty much hit equilibrium. So we make fee revenue and spread revenue. And spread revenue has been basically flat from a core basis. Now we have this one-time adjustment goes through, basically flat. What we've said is that's starting to grind up because we're actually growing the core loans, the total loans. And
replacing old stuff with better quality assets?
But just top line. The total number of loans in our portfolio has grown 2 quarters in a row. And that is while we're replacing all that other stuff. But the good news is we can outgrow it. When we had $175 billion of credit card loans down to the 90 we have today, it was hard to outpace that growth. We probably hit a bottom at 89, 90. We can now grow that back because the card production can keep up with it with the credit standards we want. So we just grind forward. That's what people said. The question, we're levered bet to the economy because it happens a lot faster, but we still can drive the revenue of our company just by good, hard work, even in a lower growth environment.
You have set there are 4 ways which you measure yourself. return on equity, return on tangible common equity, return on assets, and your efficiency ratio. We covered efficiency ratio. You want to get it to 60. What about the others? What is an acceptable ROE for this bank?
We focus on return on tangible common equity because that's the way we judge that.
ROTCE.
And we've told people that basically that at a 7.5, 7.75, almost 8% tangible common equity ratio, we think a 12%, that's a 1% return on assets divided by 8 is our equity level, gives you 12. And we used to say 14 because we were at 7, and what happened is because all the capital rules and stuff, we had to
change,
pick up more equity. So we can see that path forward. This quarter around 10.
Yeah.
And our cost of capital is probably lower than that, but that's an interesting discussion. For
philosophical debate.
But the reality is we're at 10, and with the work we see ahead of us, we got to push that up, the kinds of discussion we're having. It's all linked together. The efficiency ratio, the core revenue growth. If rates rise, the faster core revenue growth.
It'll be...
You keep doing. But I said we should get to 12% over the next few years. If we keep doing it, if rates rise, we'll get there faster.
The Fed gave Bank of America conditional approval in March to pay your dividend, to buy back $4 billion of stock. And you had to resubmit your capital plan by September 30th, which you did. Are you confident it gets a passing grade?
Well, we're confident. We've done all the work we're supposed to do. In our view, we participated with our team heavily. We've asked outsiders, are we doing it the right way? We've great dialogue with our examiners, but they've got to give us the grade, and we'll see that. They have 75 days, so we'll see it in the next 60 days.
Do you feel good about it?
We feel good of the work we've done.
What happens if you don't get that passing grade?
Well, we just would have to continue to do the work. We're already on a course to what happens next in 2016. So the work doesn't stop in these chunks. It's a continuous process.
You can't afford to stop.
Yeah, we can't afford to stop. We have to be, if you step back and think about it, why is this process so important to us? We have the numbers. You've looked at our numbers. We just got to have the confidence in the process. And then the third thing we have to have is the confidence in the earnings stream. And that you've seen come up. You put that together, then we can start to return more and more capital to the shareholders. And so, that's why it's critical to our company. Part of our investor, value proposition, investor thesis in our company is a return of capital.
Why has this company, though, had more trouble with that stress test process than it should have?
Well, I think there's more variability around us in the sense that you had more things to figure out, with the legacy issues and stuff like that. And then, we had a capital mistake a few years ago. That was just a calculation that had been carried forward for years. We found it, we reported it, and got through that. And the other time was 5 years ago now. I can't remember what happened, frankly.
Tell me about the competitive environment right now. A lot of banks want the same business because good business is good business. Everybody should want it. Where do you feel most of that competition coming from?
Well, if you look across the various businesses, it's different, because we go from general retail customers in the U.S. to wealthy customers to small business to large business, so it's different. If you think about where I think the most competitive place is, and this is good for the customers, middle market lending is very competitive right now, and so a $30 million loan in XY, one of our markets has a lot of people showing up, and we work on that by having a great client experience, having great products, and then having a unique value proposition against the competition, because often that will be companies that have global operations and global ambitions, even though they're $500 million, $700 million revenue companies, and so we can serve them. So it's heavy competition there. Consumer space. There's always competition for core bank accounts. There's a lot of banks out there. In investment banking, you can get the score sheet every day. You can look up and see how the fees came out. So the usual teammates there, we're third, we think, this quarter, and we just keep plugging away. And then in trading, there's a limited group of large investors in the world, and that's who we serve. And by the way, our other competitors are there. So it's competitive all over the place. The difference is the package of products and services we have, when you put it together, it's not close. So wealth management, number one wealth management business, card business number 3, mortgage 3, retail banking number 1, commercial bank in the U.S. is probably number 1. Maybe it's nip and tuck between us and a couple of the other big guys, but so you're not scared of them, but it is competitive.
Deutsche Bank had to give up its goal of being a universal global bank. Are you going to let J.P. Morgan and Citigroup fill that vacuum alone?
Well, I think it's our job to fill the vacuum to the extent that it's the customers and clients and the business we want to do, and we've been doing that. I mean, our market shares have been going up, even though the revenue pools have been coming down. And Tom Montag and Fab Gallo and Bernie Menza and Jimmy DeMar that run the markets business have done a good job of working our positioning against the clients.
So you will try to take some of the business that Deutsche Bank is going to have to give up?
If it's the business we want to do. I mean, if it's a business that we can do for customers. We're not in the commodities business, never have been. You know, we hedge people's commodities, but we're never in the principal business. We're not in some other businesses. So there'll be parts of it that will not be.
What do you want most? What do you think they're most vulnerable?
My view of all these competitors, and not speaking of Deutsche Bank, is the thing that we have to own in our company is a link between our issuers and our investors. And that's the capital markets activity around debt and equity raising. And we just have to drive that. And that's where, when I get frustrated, is when we lose a deal to a middle market client to raise capital in the capital markets, because it's good for our investors because we're bringing them good assets to invest in, and it's good for our company.
So if they give market share up there, you'll be going after it?
We're going after market share in all those businesses.
You know, Brian, that people say this bank is run by the Boston Mafia because they say there's too much Massachusetts on the board and the executive suite of what is mainly in North Carolina and New York and maybe San Francisco institution. Is there?
I don't even know how to answer that, because we have a talented group of teammates that have come from everywhere and are a great group, and we're making the transitions. We have people that are retiring because they're 65, and we'll replace them with teammates. So it's an interesting question for somebody to write about. I'd never thought about it.
Do you think it's important to dispel that perception?
No, because nobody in the company thinks that way.
So shareholders recently confirmed you as chairman of this company. Given the fact that some members of the board have come under criticism with the vote at last year's annual meeting, and in this process, is it time for some more fresh faces in the boardroom?
No, so I think let's wind the clock back and say what happened. Our board made a decision late last year, when our chairman was going to leave, to put the position back together. 6 years before that, 5 years before that, there was a vote that was decided by literally 30 million shares on a base of 3.6 billion, to give you a sense. And so they made a decision to put it back together. When they went out and we went to the annual meeting, the issue came up that the shareholders wanted to have a vote on that issue. And so they were expressing their displeasure with that, because the only way they could express it was to
So Tom May was targeted for that reason.
There was the whole governance committee, ISS came out against him and things like that. So it went along. I and the board made the decision to say, let's separate the two issues. Let's talk about governance, and let's talk about the directors. So the directors all got elected and went on. And then we put in front of the shareholders, in a clear, transparent way, vote on this issue.
Which they did.
And the shareholders voted to leave it. Let the board have the flexibility to make the decision based on what they feel at the time.
And that's why you're the chairman.
But that's the key, is their decision that could change tomorrow morning. Their decision that could be different if there's a new CEO. Their decision, they have the flexibility to make the decision like most of the other companies do. There's very few companies that have it mandated one way or the other way. What they have is the ability to make the decision, and that's what the board really was trying to get to, is to put our company back to normal.
You feel good, though, I take it, with the board as it's structured now?
Yeah, we've added. If you go back to 2009, before I was CEO, we had to restructure the board, and it was done. And the people that are on that board from that time are there because they had to do the work to restructure the board with the regulators after the stress that we got put under and after all the things. Those board members plus the new ones we added, it's a very strong board.
I need to ask you a couple of questions about politics and regulation. Hillary Clinton says we need to, quote, save capitalism from itself. Do you agree?
I'm not sure what she means by that, but I think if you look around, this system of capitalism seems to be the right one. This country is a country that does a great job, and you see people who follow down that road tend to create jobs, tend to create wealth, tend to create things. Then the question that most people express is, you got to deal with the fallout. It by its nature has an aspect to it, and that's why you got to have the kinds of programs and efforts that not only the country does, but not only the states do, but also companies do. And I think that's the fair balance. And so there's far wiser people than me that reflect on this as theory, but it's a really practical question, which is you need to have that entrepreneurism, you need to have that success drive to create the kind of velocity in the economy. At the same time, you need to have a societal compassion that says when somebody falls out, we take care of them. And that's a great system.
She has a pretty detailed proposal for financial reform. Is there anything about it that you agree with?
I haven't really studied it that carefully, honestly, because I think if you go back and say, what was the spirit of what
she wants to impose a risk fee on big banks. Surely you've heard about that part.
Well, today there's a risk fee on us today. I have to carry 300 basis points more capital than an institution that competes in the middle market with me. But I think that was built to make sure that we could go through a stress, and you never have to have government.
Now she wants to punish banks, not yours necessarily, based on their funding model.
But that's in the rules today. So we there's the LCR calculation, the high quality, what counts as assets, the differential in FDIC charge. Remember, the FDIC is we all put money in the FDIC, and it pays to clean up the situation. So we have to fund that, and it's funded up dramatically after the crisis, and we pay billions of dollars.
How do you interpret that stuff then? The broadsides from Mrs. Clinton, from the other Democratic candidates, Chafee, O'Malley, Sanders. They're all painting targets on Wall Street.
Well, it's a political campaign. There'll be a lot of ideas out there across the whole dimension the last person that needs to tell America about politics is me. They can go watch the debates. But let's focus on what has gone on in our industry since the crisis, on a global scale and on a thing. If you think about the 4 or 5 issues, one is people weren't regulated the same way. Now, all the participants are under the Federal Reserve regulation and banking regulation that weren't there before. So a lot of people didn't have a primary regulation. Second is capital. We went into the crisis with $60 billion of capital. We have $150 billion today. Our balance sheet was $2.7, $2.8 trillion. It's $2.2 trillion today. Think about that dimensional change in terms of what happens, right? So after the stress test, we have more capital by a lot than we had before the crisis. So after we've taken the stress, after we keep paying dividends and buy back stocks, so that capital, and that, by the way, we're not unique, that's the industry. Liquidity. We have $500 billion of liquidity this quarter. $500 billion liquidity. We had $100 billion at the time, right after the crisis. So each of the dimensions, the scope of activities, Volcker rule, ring fencing, deposit.
It's made the industry safer.
It's the industry safer, and so.
So what about those people then who want to go back to what it was like before Dodd-Frank?
I'm not sure.
Would it be good for your company?
No, we would run our company the same way. We took.
You would.
We took $12 a share in charges because we got. Whether it was charge-offs and credit cards, whether it was a mortgage business, whether it was charges.
So you see the value in the.
We see the value in the way we run the company. Run it for the customers. Stay in a prime consumer
space. But you would
space.
be with less capital. You'd be more profitable.
Yeah, but the capital is an insurance policy that it's there. The investors get it's their capital, and if we can't put it to work, it's capital on the balance sheet. We put the rest to work, and we get a good return. And that's the challenge. Is if it gets too high, then investors are going to say, can this industry ever really return a good cost of capital? But the reality is, the 300 basis points we have to carry as a buffer, we can't put to work. So it's, in our case, that number is $50 billion of capital, which is sitting there as an insurance policy to make sure that we never have to, we and our colleagues of like amount never have to touch the question of government support. So
even if Dodd-Frank were repealed, you'd still maintain that buffer?
If you go back before Dodd-Frank was passed, we took the company and we laid down a set of operating principles. Those are the same operating principles used today. Are they consistent with some of the principles that came out of Dodd-Frank? Why don't we do proprietary trading? Our customers don't want us to do that. They want to help them make money. That's our job, and that's why we built the structure.
So let me ask you this last question. What do you think is a more likely outcome at this point? What we just talked about, a repeal of Dodd-Frank, or some kind of legislation forcing banks like yours to break up?
I honestly think that we've made all these rules. We're still not even done in terms of implementation. I think the best answer is just stay the course. It's made the industry tremendously more safer. It's made the industry tremendously more simpler. We got the living wills and everything. Let's just let this operate. The numbers are staggering compared to what the capital levels and things in liquidity levels were. I think it's the best interest because the question is, how much does the insurance policy cost our ability to do things? So if you look at the industry and said there was $100 billion of conservatism built into the way the stress test works, the way the capital levels, just $100 billion across the trillions of dollars of capital in the industry, that's $1 trillion of loans that could be made at a 10% leverage. And the question is, so we built the insurance policy. Let's just let it operate, is my view.